At 73, the government starts telling you how much of your own money you have to take out of your own account. Not suggesting, requiring. And every dollar it forces out lands on top of your Social Security and your pension in the same year, which can move your tax bracket, raise your Medicare premium, and make more of your Social Security taxable. All at once. From a withdrawal you never asked for and may not need. There is a window open right now that permanently shrinks that forced number. It opened last year. It closes at the end of 2028, and this year is already more than half gone. Now here is what almost nobody covering this will say out loud, and it is the reason I am making this video rather than repeating what you have already heard. Rushing at this window is as expensive as ignoring it. There are 3 cliffs sitting inside it. Step over any one of them, and you can end up paying more than if you had done nothing at all. I have read the emails from people who found that out in April. So this is not a video telling you to hurry. It is a video about finding the right number, and the right number is different for every household watching this. My name is Kevin. I read the rules so you do not have to sit with them. And before I go further, I am not an accountant and this is not tax advice. Every single thing in this video deserves a conversation with a professional, and by the end, you will know exactly what to ask them. If that is useful, subscribe and turn the bell on, because the second cliff in this video does not show up for 2 full years, and by then it cannot be undone. So, the window. Plainly, a conversion means moving money out of a traditional retirement account into a Roth account. You pay income tax on whatever you move in that year at your ordinary rate. In exchange, that money is finished with the tax system forever. It grows tax-free, it comes out tax-free, and a Roth has no required withdrawals, so nobody ever forces you to touch it. Money left in the traditional account is the opposite. Every dollar in there is still owed to the tax authority, and starting at 73, they begin taking it on their schedule rather than yours. The arithmetic on that is simple and unforgiving. An account of around $240,000 produces a first forced withdrawal of roughly $9,000, and it grows from there, because the account keeps growing while you wait. And notice what makes that different from an ordinary tax bill. This is not tax on money you earned. It is tax on a withdrawal you did not choose, from savings you already built, on a schedule set by somebody else. There is no version of it where you say you do not need the money this year. The formula does not have a field for that. Maudie is 73 this year, and she did exactly what she was told. She taught for 31 years. When she retired, the man handling her account said the sensible thing, which was to leave it alone and let it grow. She would not need it for years. So she left it alone and stopped thinking about it entirely, which is what most people do and what most people are advised to do. Then the letter came. She is now required to withdraw thousands of dollars a year she does not need, and that money stacks on top of her pension and her Social Security, and it moved her into a bracket she had never been in. The advice she was given was not wrong, exactly. Leaving it alone was reasonable for growth. What nobody mentioned in 11 years of annual reviews was that there would be a window, and that it would open and close while she was not looking. That gap between advice about growing money and advice about what happens next is exactly why the quiet rules exists. Not clever strategy, the plain arithmetic of what a forced withdrawal actually does to a household in large print, so that a decision gets made on purpose in a year you choose, rather than arriving as a letter in a year you did not. Working it out beforehand takes one afternoon. Finding out afterward is not working it out at all. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top, and if you are watching this on your television, there is a code on the screen you can point your phone camera at. 7-day guarantee, no argument. If it does not put something in your hands you did not already have, send it back. Now, why this particular window, and why it is genuinely unusual? 2 things happened at once that have not happened together before. The first is a new deduction, created by the tax law passed last year for people 65 and older. $6,000 per person, $12,000 for a couple where both qualify. It sits on top of your ordinary standard deduction and on top of the additional amount that has always existed for being over 65. You get it whether you itemize or not, and it is temporary. It covers tax years 2025 through 2028, and then it is gone unless Congress acts. The second is that the same law made the current tax rates permanent. They had been scheduled to rise, they did not. Put those together. A temporary deduction that pushes your taxable income down, sitting on top of rates that are not going up. That combination is what makes a conversion cheaper right now than it was 2 years ago, and cheaper than it will be in 2029. That is the window. It is real, and the arithmetic behind it is sound. Now the 3 cliffs, because this is where people lose money going the other direction. The first cliff is the deduction itself. It shrinks once your income crosses $75,000 single or $150,000 married filing jointly. For every dollar above that line, you lose 6 cents of it, which means a conversion that pushes you past that threshold does 2 things at once. It adds taxable income, and it removes the very deduction you were relying on to make the conversion cheap. Your bracket says one number, your actual cost is higher. And that phase-out has an effect people find genuinely surprising when it is spelled out. Inside that range, your true cost on the next dollar converted is meaningfully higher than the bracket on the chart, because you are paying the bracket and losing part of the deduction at the same time. Which is why the answer to how much should I convert is never simply fill up your bracket. Filling up a bracket is the advice everybody gives, and it is the advice that produces the worst outcomes in this specific window, because it ignores everything sitting on top of the bracket. The second cliff is Medicare, and this is the one that catches people who are otherwise doing everything right. There is a surcharge on Medicare premiums that applies when your income crosses a threshold. For this year, that first threshold is $109,000 for a single person and $218,000 for a couple. 2 things make it dangerous. It is a cliff rather than a slope, so $1 over moves you into an entire tier. And it uses your income from 2 years earlier, so a conversion you do this year sets your Medicare premium in 2028. By the time you see it, the year that caused it is closed. There is no appeal for a voluntary conversion. Herschel is 71, and he is the reason I am spending time on this, rather than just telling you to convert. He is a retired accountant. He understood conversions perfectly well. He had been doing them deliberately for years, and he was not being reckless. He simply converted a larger amount in 1 year than he had in previous years, and he did not run the Medicare number because Medicare had never been part of the calculation before. He crossed the threshold, not by a lot. And that single year now sets what he pays for Medicare 2 years later, and there is nothing to file, nothing to appeal, and nothing to undo. He did the right thing at the wrong size. That is a completely different mistake from Maudie's, and it costs real money too. That is exactly what the guide is built to prevent. The 3 numbers to check before moving a single dollar, written plainly and in large type, so that a decision meant to save you thousands does not quietly cost you a Medicare surcharge you will be paying 2 years from now. For somebody in Herschel's position, the difference between the right amount and slightly too much is measured in thousands of dollars. Same place, kevinexplains.shop, in the description and in the pinned comment, and the code is on your screen if you are watching on the television. 7-day guarantee, every single time. A careful man doing the correct thing in the wrong quantity, finding out 2 years later. The third cliff is your Social Security. If you are already collecting, conversion income counts toward the calculation that decides how much of your benefit is taxable. Below $25,000 single or $32,000 married, none of it is taxed. Above $34,000 single or $44,000 married, up to 85% of it can be. So a conversion that pushes you across that line is not just taxed on its own. It reaches back and creates tax on money you were already receiving and had already paid tax on once during your working life. And there is a detail inside that one worth knowing, because it decides how much of your benefit gets caught. Those thresholds have never been adjusted for inflation, not once since they were written decades ago. A figure designed to catch wealthy retirees now catches a very ordinary household, purely because it stood still while everything else moved. So for a great many people watching this, the Social Security line is the first of the 3 cliffs you will reach, not the last. Which means the conversion amount that actually fits your situation may be considerably smaller than any general advice would suggest, and that is not a failure. A smaller conversion done every year for 3 years, staying under every line, beats one large conversion that crosses 2 of them. Now here is who is in the single best position, and if this describes you, you should be paying close attention. Somebody retired, not yet claiming Social Security, not yet on Medicare, living on savings or a small pension, and at least one spouse 65 or older. That household has almost no ordinary income, so their bracket is at the bottom. Social Security is not being pushed toward taxation because they are not receiving it yet. The Medicare surcharge does not apply because they are not on Medicare, and they qualify for the new deduction. Every one of the three cliffs is out of reach at once. That combination lasts a few years at most, and it is the cheapest moment to move money that most people will ever have. And an enormous number of people in exactly that position are waiting, because waiting feels prudent. So here is what to actually do, and it is 5 things. 1. Find your last tax return and locate your adjusted gross income. That single number tells you how much room you have before each of the 3 thresholds. Everything starts there. 2. Work out your future forced withdrawal. Take your current balance and divide it by roughly 26.5, which is the figure the tables use at 73. That is approximately what will be pulled out of your account in the first year, whether you want it or not. That number is what you are trying to reduce. 3. Confirm you are actually claiming the senior deduction. A great many people who already filed last year did not, because nobody told them it existed. If that is you, ask a professional about amending that return, because it is recoverable. 4. Before moving anything, write down your 3 limits: 75 or 150,000 for the deduction, 109 or 218,000 for Medicare, 34 or 44,000 for Social Security. Your conversion has to stay under whichever one you reach first, and for most people, that is the Social Security line by a wide margin. 5. Pay the tax from outside the account. If you convert and take the tax money out of the same account to cover it, that portion never reaches the Roth and never grows there. Pay it from savings, so the whole amount goes to work tax-free from the first day. And one more thing worth knowing, because it removes a fear that stops people entirely. There is no minimum. Nobody requires you to convert a large amount, or to convert the whole account, or to convert it all. Moving a few $1,000s in a year where you have room is a completely legitimate use of this, and 3 small conversions across 3 years is very often the better version of the same idea. The people who lose here are not the ones who move too little. They are the ones who move nothing, and the ones who move too much in one go. And one thing not to do: do not do this in December. Almost everybody does, and it is the worst month for it, because you have the least room left to adjust if the number turns out wrong. The clean version of this happens in the middle of the year, with most of your income known and time to correct. If you are looking at your own numbers and cannot work out which threshold you hit first, email me. The address is on your screen and in the description below. I read every one that comes in. Maudie left it alone because that was the advice, and the window opened and closed while nobody mentioned it to her. Herschel understood all of it and moved slightly too much in a single year, and will be paying for that in 2028. Neither of them was careless. One waited and one hurried, and the cost was roughly the same, which is the strangest thing about this entire subject. And that is really the whole of it. This is not a video asking you to understand the tax code or make a large decision quickly. It is asking you to find one number on one page and compare it against 3 lines. There are 3 tax years left in this, and one of them is more than half spent. That is not a reason to rush. It is a reason to sit down this month with your last return and a pencil and find your own number before the room to use it is gone. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.